particular topic or why you're studying that particular subject, so that's why I would like to first begin by introducing why we're doing this chapter, material costing. So it looks like something stuck. Just give me a minute. Okay. So now whenever you, talk about any company which is dealing with a particular product, the product is not just formed, out of nowhere. There is some inputs that go into this product. There are some items, some materials that go into this product. So if you don't understand what is going into the product, if you don't understand how to calculate the costing behind this product, you will not be able to understand the end result of the final value of the item that you're going to sell. So if let's take a small example, a chocolate, right? A chocolate is not just, you just don't get a chocolate from somewhere. You have to put milk, sugar, so many other ingredients that go into it. So if you're not aware of what is going into it, what is the costing of each item that is going into it, it will be very difficult to understand and analyze what is the end cost or how much you should sell that chocolate for. So it's very important to know what is going inside that chocolate to be able to understand the entire costing system. So a few benefits that I can say in terms of having a material costing is you will know what is the quality of the final product. So if you know that I'm going to put the best milk in the chocolate, I'm going to put the best refined sugar into the product, then you will end up, or the best recipe that's going into the product, you will end up having the best chocolate outside, right? So if your input is good, your output will also naturally be good. So that is one of the benefits of, understanding your material that is going inside that product. Secondly, of course, the most important, the price of the final product. If you don't know the input cost, you will not know the output, total output cost. Production continuity. Now, if you need to know, that you have to produce a certain amount of items, right? Then you will need to know that I've got a message saying, Ma, will you be taking the class in detail? No, I'll just be giving a little brief, but I'll try to, what I'm doing is I'm trying to cover all the illustrations from the ICI material so that the students are aware of all the concepts that need to be applied. And when they get a new question in front of them, they have an approach of how to do it. So that will be my, process to the class today. I hope that clarifies the question. Okay. So now coming back to the reasoning behind material costing, the price of the final product, production continuity, to know how much items should be there in stock for you to end up producing that particular output final product is very important. Otherwise, you will not know when, how much is needed, how much to stop. That's very important. Wastage and other losses, to know, if something is going out of hand, to be able to control things, and regular information about resources. So roughly, this is what material costing is all about. To know what kind of a product you need, what kind of an input, what kind of total costing, final product. So overall, to know what you're selling, to overall to know how much you're going to sell it for and how much it costs you, you need to know what the material cost for that product is. So let's get into the next slide. So if you can see, material costing roughly has these many topics. First is the valuation of the material receipt. So to understand what is to be included in the cost of that item, that's number one. Second, inventory control by setting quantitative limits. So how do you understand how much to order, how much to keep, how much is the maximum items you can have? So that kind of a control over your inventory, that we look into. Inventory stock out. So in case you need a buffer, you need a safety stock, that's something we look into. Then again, inventory control in terms of relative classification and inventory turnover ratio, cost price methods, and treatment of normal and abnormal loss. So is everybody following till here right now before we begin? Okay, perfect. Please feel free to interfere and ask a question if anything is not 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 able to comprehend with something. So let's start with the first. Are you able to see my entire screen, or is there any thing that is disturbing you? Because I put the chat on the side, so I don't know if that is covering the screen. Is the entire screen visible? Okay, perfect. So let's start with the first part, which is the valuation of the material receipts. So you need to know what are the items that you will include in the costing and what are the items you will not include in the costing. So now you know that when you purchase the item from the supplier, of course, the purchase price will go into the costing. That is, there's no doubt about it. If you're buying 500 units of uh, water bottles from a supplier at 200 rupees, the 200 rupees is the purchase cost, which will for sure go into the costing of the product. But what issues happen is whether trade discount will go, cash discount will go, the subsidies will go, the taxes will go, whether these items will go in or go not go. So that we look into a little bit in more detail. So first classification is for discounts and subsidies. Trade discount. Now, there are two types of discounts generally, trade discounts and cash discounts. Trade discounts is something which the supplier will give you anyway. It is not depending upon whether or not you will make the payment to him early or later. So trade discount is like if you purchase like 500, more than 500 units, I will give you a 20% discount. The supplier tells it. So this is definitely for sure a part of a discount which is specific to that product. So definitely a trade discount has to be reduced from the product. Second is a quantity discount. Quantity discount is very similar to a trade discount. It is the same treatment. You will have to reduce it from the product cost. Now, cash discount is something which is not deducted. Why? Because cash discount is something like, a reduction. It's like an interest uh, gain that you get. Because what the supplier says is that if I'm selling you 500 units and you make the payment within the 10 days, first 10 days of the uh, sale, I will give you a 2% discount. So here the supplier is looking to benefit by taking that additional, he's getting the amount in advance and he will in turn use it like, to invest it somewhere and get an interest income. So it's technically like an interest risk. So you cannot be using a cash discount as something pertaining to that product because it is completely dependent on whether or not you're paying it in advance or not. So when something is not pertaining to the product, it cannot be deducted. So that's very simple. I hope this clarifies the difference between trade discount and cash discount. Subsidies. Again, subsidies specific to the product received from the government will have to be deducted. Is it clear till now? Then, okay, now moving on to duties and taxes. For duties and taxes, you need to know that whatever taxes you pay generally, you will have to, it is an expense, it is a cost, right? So when you're paying a road tax or a toll tax, it is a cost. So when generally when the vehicle is taking the goods and passing by the toll, you'll have to pay a toll cost, right? So that toll cost will definitely be included in the cost of purchase because you're not going to get that refund. You're paying it for the good and you have to pay it. You will not be receiving any refund for this. So definitely road tax will have to be included in your cost. Next is your GST. GST, you need to understand. GST, I'm sure you know that you will get a refund for the, like basically it will be a net off, right? So you have a GST receivable and a GST payable. So GST receivable and payable will never be part of your costing of the product because that has to be treated separately. That is something that the government will net off and take it from. So technically, this is not even your expense. It is the customer's expense. So GST is not something that you will include into the product. Custom duty definitely included because you're not going to get a refund for this. So this is how you need to remember that if you're not getting a refund for that product, that tax, then you will have to include it. If that the refund is being receivable or payable or something of that sort, definitely don't include it in the material cost. That's for the taxes and duties. Then when you go to the penalties, demurrage. So demurrage is a penalty which is imposed by the transporter for delay in uploading or offloading of materials. It is an abnormal cost. So it is not something that happens knowingly. It is an issue that it is a mishap that happens. So when it is not meant for the product, it is some situational based issue. Definitely don't include it in the cost of purchase. Detentions, charges, fines. Again, these are ruled by law, by statutory authority. You cannot include it in the cost of the purchase of that item. It is something that you made a blunder, you made a mistake, you have to pay for it. You cannot be including it in the cost of the purchase of that product. It's not directly related to the purchase cost. Penalties, again, same concept, penalties and charges. Other expenditures, insurance charges. Many times suppliers, whoever purchasers who buy products, they will insure the vehicles and freight. That is directly related to the product of the good, definitely added with the cost of purchase. Commission or brokerage charge. Commission or brokerage paid is added with the cost of the purchase. Again, because it will be paid for receiving the goods, correct? So directly related to the good, added to the good. Freight inwards, it is added with the cost purchase as it is directly attributable to the procurement of the material. Cost of containers. Now, treatment of cost of containers. You need to understand there are two types of containers. One is where when you're bringing the products, it will come in big vehicle containers, right? It will not just come like that. So sometimes these containers have to be returned to the supplier. And when you're returning it to the supplier will give you a refund for that container. So when he's going to give you a refund, you know that you're anyway going to get that amount back. So you are not going to include it in the cost of purchase of that item. But if you're not going to get a refund for it or you're not going to return these containers, then that amount is definitely going to be added in the cost of your purchased item because you're not going to get a refund for it. You have to bear for the cost. And why are you bearing for the cost? For buying that items in that particular container. So definitely the amount of the cost of the container will get included in the product cost. The last part is your shortages. Now, sometimes what happens is, let's take an example of petrol. When petrol or oil has a very natural tendency of getting evaporated. So if you would have ordered for, let's say, 500 liters of petrol from XYZ country, it reaches your country and it will have a reduced amount or an increased amount depending on the weather conditions. And that is for normal reasons. You could not have avoided it. So when some loss happens for normal reasons, it gets absorbed into the good units of the item. So you will not be separately handling this under costing P&L. It will be a part of your product cost. The second type of shortage is for abnormal reasons. So supposing you could not sail the ship properly and few containers fell down or some amount due to mishappenings of which is not normal. You made a blunder or there was a issue that happened because of which there's a shortage, then definitely that loss will not be absorbed by the good units. You will have to transfer it to costing P&L. So these are the total items that you have to consider in terms of your material costing. I hope the logic behind all of this is clear. If there's any doubt, please let me know because next we will be proceeding with the questions. Is it clear? Okay. All right. So this is the first. There is a question. What if credit is available on GST Pay? That's perfect. So if credit is available, then definitely you don't have to include it in your cost because you're going to get the refund for it. So why you have to bother about this? Only when credit is not available on things, when you're not going to get the refund, then you will have to include it in the cost of the product. Fussy, is that clear? The question? Okay, perfect. So here's a question from the from a study material itself, and if you want to start, we can you can start by yourself. The ones who already can do it, but I will prefer to do these questions together with you. So the first question is about calculating the inventory cost. So let's read it out. An invoice is in respect of a consignment of chemicals A. Oh, 1 minute. An invoice in respect of a consignment of chemicals A and B provides the following information. Chemical A, 10,000 kgs at 10 rupees per kg. Chemical B, 8,000 kgs at 13 rupees per kg. Basic custom duty at 10%. Credit is not allowed. Railway freight, total cost. A shortage of 500 kgs in chemical A and 320 kgs in chemical B is noticed due to normal breakages. You are required to compute the rate per kg of each chemical, assuming a provision of 2% of further deterioration. Now, before I get into the answer, just to briefly summarize the question itself for you all. What do we notice here is a few points that we need to take care of. The first thing is basic custom duty credit not allowed. So just like I explained, when the credit is not allowed, definitely that amount will go into your costing, because you're not going to get any refunds for this. The second thing to note here is the normal breakages. So just like I told, if the shortage is for a normal reason, which is not in your control, that will get absorbed into your cost of goods. So when you say absorbed, that means when you will calculate the total kgs that you have received, you will have to reduce the amount that has been normally lost, because because when you calculate your total cost per kg, it has to be for your kgs less all the normal losses that are subject to that particular item. So let's start with answering this question. So the first part is we will compute the effective quantity of each chemical available for use, that is after the items have been reduced. The quantity of normal loss has been reduced. The first thing is the quantity that has been purchased. So we have 10,000 units for chemical A. And I would like you all to also solve along with me. And if any one of you has found the answer, you can also put it in the chat box so we can see who all are following, ahead of class. So the first thing we see is the quantity purchased. Now we know that there is some shortage due to normal breakage. Oops. So that was given in the question to be 500 and 320. Now, if you look at the net, you'll have okay. So now if you read the question, it says there will be a further reduction of 2% of the amount. So you will reduce it by another 2%. So what is, if you take out your calculators and calculate 2% of 9,000, it's coming to 190.
Niamath.
And if you take, hello, is there a question? If you take 2% of 7680, it comes to 153.6. And then you have the total quantity available, which will be 9,500 minus 190. And similarly here, you will have 752. Is everybody following me till here? So the reason we calculated the net quantity is simple, because this is a normal loss. When it is a normal loss, your net quantity available will reduce the normal losses and then be calculated. So when we proceed further with the computation of the rate per kg of each chemical, this is how it will go. So we have the purchase price, which was rupees 10 and rupees 13 per kg. So we have 10,000 into 10, and we have 8,000 into 3 into 13, sorry, which is 1,04,000. Then we add the custom duty, which is 10,000, 10%, which is 10,000 of this. And 10%, which is 10,400. Then we have something called the railway freight. Railway freight is kept as 3,840. Now, how do we divide this? Do we divide it in 10,000 and 8,000 kgs, or do we divide it as 9,310 or 752? The answer is we will be dividing it on the basis of the quantity purchased. Because when you are paying for the freight, the supplier is not going to consider your normal losses. The supplier is going to charge you for your 10,000 and the 8,000. The freight is on the total quantity that is purchased. So whenever the freight is on the total quantity purchased, the freight should also be divided on the basis of the total quantity purchased. That is in the ratio of 10:8. So we will again add our freight here. So that will be, so our freight is coming to 3,840. If we do 3,840 into 10,000 divided by 18,000, it comes to 2,133. And over here it will be 3,840 minus 2,133, which is 1,707. That gives you a total cost of 1,12,133 and 1,16,107. Our effective quantity that we calculated above is 9,310, and the effective quantity that we calculated above is 7,526. Why are we using now this quantity is when we calculate the cost per unit for our costing purpose, we will consider the quantity available to us and not the quantity purchased. Because if you are doing a costing, you have to do it based on what you have in hand, and you cannot do it with what you have purchased from the supplier. So here you will get the rate per kg calculation, which will be 1,12,133 divided by 9,310, which is coming to 12.04. And here it's 1,16,107 divided by 7,526, which is coming to 15.4. So is everybody clear with this? If you have any confusion, any doubt, if I was too fast and if I'm too slow, please let me know in the chat box so that I can make the corrections accordingly for the further illustrations as well. So I see Rania has put the answer. That's great. How about the others? Are you all following, or do you think I'm going too slow or too fast? You want me to change the speed? Okay, so everybody is following, right? Can I get a show of hands, a thumbs up or something? Okay, so it's clear till here. Okay, great. So this is how you will have to get your final rate per kg. Let's move into the next illustration that we have. So things to take back from this question, I would say, is that you need to calculate the effective quantity to identify the rate per kg. Because rate per kg is something. Now, let me explain why you need this rate per kg. So when you are costing, when you are preparing a cost sheet for your final product, like let's say the same example of a chocolate. When you are making a cost sheet for a chocolate and you want to see how much this chocolate costs, you need to know what is the material cost I can put for this chocolate. So if I need to know what is the material cost put for the chocolate, I need to know the rate per kg of that item that I'm putting in. So if I'm putting in like 100 kgs of sugar into producing that chocolate, each unit of the chocolate costs me how much. So that is why the whole logic behind calculating the rate per kg comes. The next is the freight. The freight is always distributed based on the quantity purchased, unless otherwise stated in the question. And any normal loss should be absorbed into the cost of the product. So if you see here, these normal losses have been absorbed into the 9310 unit and 7526. So the entire cost of the product is absorbed into the actual quantity available, and we are not separately treating the normal losses. So I hope this is clear. So let's move into the next question now. At what price per unit would part number A32 be entered in the store's ledger if the following invoice was received from a supplier? So 200 units at rupees 5 is what we have purchased it for, reducing a discount of 20%, which is 200 rupees, giving us 800. GST at 12%, packing charges for non-returnable boxes, which is 50, giving you 946. A 2% cash discount will be given if payment is made in 30 days. Documents substantiating payment GST are enclosed for claiming input credit. So three things I can note here is that first, 20% discount. This is what? A trade discount or a cash discount? I'd like to see in the chat. Okay, great. So it's a trade discount. And the treatment for a trade discount will definitely be a reduction from the cost. Perfect. GST at 12%, it is a it is an amount which is saying that it's enclosed for claiming input credit. So do you think the GST will be deducted or it will not be deducted? I mean, it will be added or it will not be added. Exactly. So not to add. Perfect. Because it is available. Great. Packing charges of 5 non-returnable boxes. Since these boxes are non-returnable, do you think we will add it or not add? Okay, Rania says added. Chestnut says add. Priya, perfect. So it will definitely be added. Great. Good to see the good responses from all the students. It's wonderful. So here we can see that we are already aware of how this has to be gone about. So I will just quickly like run through the answer. And I would suggest you take a screenshot or whatever, so that you can also simultaneously, practice on the answer by yourself. And once I'm done, we can verify whether we have come across with the right answer or not. So the first thing is we have 200 units at 5 rupees. So that will be 200 into 5. That is my purchase cost. And then we have our discount. We have our discount, which is for 200 rupees. So we get a total of 800. Then we add our packing charges, which is of 50 rupees. That gives me a total of 850. Okay, and then we have number of units, which is 200. So we get a total of 850 divided by 200 units. Time cost. And this is what we require. So everybody's good. Okay, Pizza, Archana have got the right answers. Pratyusha, Tasneem, wonderful. Okay, so I think we're good till here. Let's move into the next part, which is the most important part, which is inventory control by setting quantitative limits. So I hope everybody is having a good idea, a fair amount of how to calculate the material cost, what's included, what is not included. And once you have your fundamentals clear, when you practice more questions, everything, you'll get a better hang of it. My purpose here is to give you that fundamentals and to understand the concepts, to have a refresher of all the concepts so that you can go about with things when you're practicing by yourself. So the next part is inventory control. So here we can see there are multiple things. We have a reorder level, we have a reorder quantity, maximum level, minimum level, average level, danger level, and buffer stock. So let me give you a brief example to clarify this. So the first thing is that I would want you to, not mug up formulas, because that is a blunder that you will do if you start mugging up formulas. Yes, there are a few formulas that you need to memorize, but apart from that, you don't need to memorize most of them. So now let's get into material costing formulas. The first thing is EOQ. So we are talking about inventory control here. Now, when we talk about inventory control, the first term is reorder quantity. What is reorder quantity? Reorder quantity is basically the amount of units of items that you need to uh, place an order for, so that your carrying cost, your order cost, and all the costs associated with that item is at the most optimum level. So what does that mean? So let's look at an example here. We are looking at an example for the calculation of EOQ, annual requirement. So let's say you are in a juice company, okay, and the juices that require a particular chemical or a particular liquid in that, or a fruit that is required. Let's take a fruit. So the fruit that is required for that is 10,000 units on an annual basis. When you order for the fruit, you have to pay 50 rupees for each order. When you are storing this item in your uh, goods, you have something called storing this item in your inventory, you have something called as a carrying cost. What is a carrying cost? If you are ordering something and keeping it, if you're ordering something, you need to keep it in your inventory, correct? So when you're keeping something in your inventory, you have to spend for a carrying cost, which is the rent of that warehouse, or for some interest rates paid on that rent, because maybe you would have borrowed that amount for the rent. So there are many costs associated with just keeping that inventory. That is called the carrying cost of that item. So here we can see that the carrying cost per annum is 8% on the average inventory, and the cost per unit is 2 rupees per unit. So this is something you will always need to know when you're calculating an EOQ, which is the optimum quantity to be ordered. Yes, EOQ has a formula, and the formula is something that you will need to remember, because it is a derived formula. This is the formula. If you look at it, EOQ is equal to 2 into the annual requirement into the cost per order divided by the carrying cost per unit per annum. So you have to be very careful here that we always will consider the annual requirement of the item and the carrying cost per unit per annum. So for the year, how much it takes to carry that item is what you need to consider. So if you look into this example that I've drawn, we have all the items present here. So carrying cost per annum is coming to 8% of the inventory. So we know that the cost per unit is 2 rupees. So if we take the carrying cost, it is coming to 8% of 2 rupees, which is 0.16. So this becomes my carrying cost. So when we move into the EOQ formula, you like same like what is mentioned here, it's the square root of 2 into B5, which is the annual requirement, into the order cost divided by the carrying cost into the cost per unit, because that is the carrying cost. And when we calculate it, we come to 2,500 units. So what is this 2,500 units? So if I needed 10,000 units of that strawberry for that fruit juice for a year, then when I am placing my order, I will place an order for 2,500 units. And so how many orders will I place? It's very simple. You will take the annual requirement and you will divide it by the EOQ formula, which is the 2500 units. So there will be 4 orders that will be placed for 2500 units each, which will sum up to 10,000 of the annual requirement. So the basic thing you need to remember in an EOQ formula is that you need to get the optimum quantity to be purchased, where your carrying cost, your order cost is all at the optimum level. You're not spending more, you're not spending less, it's just right. Now we have understood what is EOQ. From the EOQ, we will derive what is the reorder level. From here onwards, I wouldn't want you to by heart any formulas, but maybe understand the concepts. Reorder level, so we know that we have, let's take an example of a client named Tesla, and the raw material required here is batteries for the Teslas, right? So this is a situation where you need to know a few things. This is very important, so pay attention. You will always have 3 situations in a company. A situation where the items being sold are not too much. It is a, let's say, a recession or a low period. So the amount of items purchased for your end product will also be on a minimum level. So that is a situation where it is minimum. A normal situation is where you will be paying, where generally how much your sales happen on a normal level. That's the second situation. And the third situation is maximum sale. So when it's a boom period where everybody's buying your products, definitely you will need more inputs to produce your final goods. So that's the maximum situation. You have a minimum, normal, and a maximum situation of an organization. So if you see the input, that is the minimum input that would be required would be 25, and the minimum number of weeks, or basically the reorder period, the minimum reorder period it would take for it to come would be 4 weeks. So you can see the batteries used per week is 25, and the minimum time taken for it would be 4 weeks. On a normal situation, 50 batteries used, and it will take around 5 weeks for it to come. On a maximum period, it will take you 75 batteries to be used per week and a reorder period of 6 weeks. When we calculate a reorder level, we basically want to cover up to the max we can, and we shouldn't be losing any sales. So that is why we will consider the maximum situation, which is the maximum batteries that we'll use and the maximum time it will take for it to come. So that is nothing but 75 into 6, which gives us a total of 450 units. So when we are at 450 units, what will happen is we will place an order for our EOQ, like we calculated above. So 2500 units was the EOQ, and at 450 units, when we reach 450 units, we will place an order for the EOQ. So why do we have to do maximum? Why do we have to do 75 into 6? Why is that? Is because when at week 6 we are at 450, every week you will be consuming 75 units. In week 5 it will become 375, in week 4 300. You can see every day it is getting reduced by 75 units, and at today, that is after 6 weeks, it will become 0. But the good part is, at this point, our supplier would have made the sale of those 2500 units, because the maximum time he will take to give us the items is 6 weeks. So that is why we will consider 75 into 6, because by the time we have consumed this, and by the time we reach the point of 0, we would receive the EOQ amount. And this is the max we can consume and the max time it will take. So beyond this, it is not going to go. So we have covered for all the loss we could possibly incur. So that is how the reorder level is calculated. So if I may ask, what is the formula of a reorder level? Can somebody tell it to me in the chat box? Is everybody following? What did I say? Okay. Right. So Jasnath has correctly responded, saying max consumption into max or reorder period. So I think you've understood the logic now. So from now onwards, I do not want anybody of you to mug up this formula, because it's got a very logical explanation to it. So I hope you understood the logic behind this formula. Yes. So shall I proceed? Okay. So now we move into the next one, which is our maximum level. Pre-order level was just to add over here. Sometimes organizations would also want to maintain a buffer stock. So when they want to maintain a buffer stock, we will also add that kind of a buffer stock to this 450 units that we calculate. Simply because they just want to maintain that. So it might be like, you might have a buffer of 50 units always. You never want to reach the point zero. Buffer always has to be maintained. So that 50 units is always required. So what will your final ROL be? It will be 450 plus that 50 units of that buffer that the entity wants to maintain. So this is how you will calculate your reorder level. Now moving on to the maximum level. Maximum level is, for example, to remember this, to remove least losses to calculate maximum gains. Now let's take your CA course, for example. You are approaching your exams and you just have 1 week to study, right? If you just have 1 week to study, you know that you want to make the max out of this, maximum output you want to gain, maximum hours you want to study in this 1 week. But of course, you will have to do certain things like eating and other activities which cannot be avoided. So what is the minimum amount of time that you will give to these items? You will remove it. So out of the 6 days, let's say some 40 hours goes into these activities. Like let's say you have a total of 100 hours left, right? You want to plan for 100 hours. So in 100 hours, 30 hours is going into these non-value added activities like eating, sleeping, etc., because these things cannot be avoided. Minimum time that you give to eating, etc., has to be removed. Kam se kam, like minimum. So when you look at the ROL here, how we calculate the maximum level, that is the maximum stock you will want to keep. So why are we calculating this maximum level? Is because you want to know how much is the maximum stock you can keep if you want to keep it in your warehouse. Because if you increase that amount, then you might have to rent another warehouse. You might have to pay additional rents for that. And that's a total waste of cost and time and amount that you're spending. So you need to know what is the max you can keep so that everything is optimally utilized. So how do we calculate this? Is first you will take your ROL, which is your 450 units, because that is the time at which you will be reordering your goods and you will be placing an order for your EOQ. But by the time you will receive this, that is, if you look back at, this table, it says that minimum utilization will happen of 25 batteries and of 4 weeks at the least you will receive. Just like I gave you the CA course example, at least 25 units will be utilized and it will take at least minimum 4 weeks for it to come. So by the time these 2,400, 500 units arrive to your warehouse, you would have utilized 25 into 4 weeks worth of consumption, which is 100, leaving you at 350 units. So at 350 units, you will receive your 2,500 units of EOQ, which will give you 2,850 units. So this is the maximum level of goods that you can keep in your inventory at any point of time. So I hope you understood this logic also. So the formula here is ROL minus the minimum consumption that you will have to make plus your EOQ amount will give you your maximum level of good units that you can keep in your warehouse. Is this clear, or is there any other, is there a confusion here? So I'll just write down the formula here for the maximum level. ROL minus minimum consumption plus your EOQ will give you the maximum level. And moving into the last one, which is your minimum level, it's very simple. When you will make the repurchase at your ROL level, which is when it will reach 450, minimum will be like what is the least amount of items that you would want to maintain in your inventory for that particular item. So here you will take the ROL and you will reduce it by the normal consumption, because you want to see the least amount that you can maintain. So when you say the least amount, you will at least consider the normal consumption that you want to utilize that inventory for. So here your minimum level will become your ROL minus your normal consumption, which is your, if you look back here, 50 weeks, 50 batteries used per week for, and it will take you 5 weeks for those batteries to reach. That will be 50 into 5, which will be 250 batteries. So 250 worth batteries would have been consumed on a normal basis by the time your EOQ arrives. So when you place an order for your ROL, we go back to this formula. So at 450, you would have placed the order. And by the time the item arrives, it would, on a normal basis, you would have consumed 250 units, leaving you with 200 units. So 200 units is the minimum amount of items that you would have kept in your inventory, because by this time, you would get the EOQ amount. So below this, you don't want to reach, because then it will become an issue, because then you will not be able to meet even your normal consumption. You want to be able to meet your normal consumption at least. So that is how we come at the minimum level formula, which is ROL minus normal consumption. When I say normal consumption, it is normal consumption into your normal reorder period. When you say minimum consumption, it is minimum consumption into minimum reorder period. So these are the three formulas which you can understand it logically and keep it in mind, so that you don't have to remember formulas at the exam time. It's very important to understand the logic so that it's clear at the time of the exam. You don't have to, hurry up and see what formulas you need to remember, because this logic has to apply and it has to be in your head when you are preparing for your questions. So can we move to the questions now, or is there any confusion with respect to these three concepts? Okay, Ashmal says clear. Anybody else? Okay, so once we do a question, maybe it would be you will understand it a little better and you will be more clearer with it. So here we can see an illustration which says compute the EOQ and the total variable cost for the following. The annual demand for the item is 5,000 units. The unit price is 20 rupees. The order cost is 16 rupees. Storage cost 2%, interest rate 12%, obsolescence rate 6%. Determine the total cost that would result if a new item of 12.8 is used. So before we go into the question, if anybody wants to take a screenshot, they can take it. So here we can see that we have the annual demand, we have the unit price, we have the order cost, and then we have three percentages here: storage cost, interest cost, and the obsolescence rate. So if you remember, in EOQ, we need three items, which is our annual demand, our order cost, and our carrying cost. So when you see these 3%, these are part of your carrying cost. Why? Because carrying costs, like I explained, to store the inventory, the interest rate paid on that amount, and an obsolescence rate. What is an obsolescence rate? It is basically like, when you are keeping an item in the inventory warehouse, it will gradually lose its value over time. So there is an amount of value that it is being losing. For example, a technological product. If you have kept a computer or a laptop for, let's say, 4 to 5 months, in that 4 to 5 months, a new version, a better, processor, a better system, something or the other would come up. And this one which you have in your warehouse would have lost its value. So that is what is an obsolescence rate. So this is all the cost you pay to, hold that inventory in the warehouse. So let's calculate this now. If you look at the storage cost, it's at 2%. If you looked at the interest rate, it's at 12%. If you looked at obsolescence rate, it says 6%. So the total percentage is 20%, and all these percentages are per annum. And this is calculated on the carrying on the cost of the inventory. So which is the cost of the inventory, the unit cost is 20 rupees. So if you look at 20% into 20 rupees, it will give you 20, just calculate on my calculator, 20 into 20% will give you 4 rupees. So your total carrying cost in terms of rupees will be 4. Did everyone understand this? Yes. Apart from Jasnath, anybody who got the answer for this? Prajista has said 200 units. Okay, perfect. That's great. Okay. So let's calculate the AOC right now. So A will be our 5,000 units. O is our 16 rupees. Carrying cost is 4. So that gives us a EOQ of, let's calculate on a calculator, 2 into 5,000 into 16 divided by 4. Rooting it will give me 200. Has everybody got this answer? Anybody who is not able to follow or is having a confusion? Okay, I think many of you in the chat box have gotten it. And now we proceed with calculating the total cost. So we have the purchase cost of 5,000 units into 20 rupees, which is 1 lakh. Then we have an order cost of 5,000 units divided by 200. So how did we do this 25? Because we need to have an annual demand of 5,000, which is meant by 200 units each. So we will be ordering around 25 orders, right? So when we have 25 orders, so 25 into 16, which will give me 400, plus the carrying cost of inventory, which is equal to 200 divided by 2 into 4. A total cost of 1,800,000. Now, whenever you calculate the carrying cost, you need to remember that it will be on an average inventory. That is why you saw that I have done a 200 divided by 2. So even though my, at a point in time, I will be ordering 200 units, but the carrying cost will be always at, screen is stuck. Are you able to see my screen now? Should I reshare it? Is it better now, Prajita? Yeah, is it seen? No. Is anybody else also facing the same issue? Prajita, maybe you can just see if, yeah, okay, I think it's fine. I got a message. It's fine. So I think Prajita, maybe you can just try to like reconnect to your Wi-Fi and then you should be able to view it. Please try. Yeah, okay, perfect. Thank you. Thank you for that. So everybody is clear with the carrying cost, right? Don't forget to always calculate the average inventory and then multiply it with your carrying cost. Carrying cost always has to be calculated on average because you will not always have 200 units in your inventory, right? Some amount of it will always be being utilized. So that is why we calculate an average of dividing it by half and calculate the carrying cost. So has everybody arrived? I think somebody told the answer to be 144. Rania, 1,14,400. Rania, can you tell me where you saw, where did you get stuck or where is the miscalculation? And are you able to follow what is the correct answer? Okay. Let me know, Rania, if there's any confusion, then we can look into your doubt. So proceeding with the next part of the question, which is, it was mistake or unit figures. Okay, no worries. That happens all the time. Okay, so now if you go into the second part, it says determine the total cost that would result for the items if a new price of rupees 12.8 is used. So initially our cost was 20 rupees, correct? When we looked here, it was 20 rupees, but now we're going to use it 12.8. So if it is 12.8, our carrying cost will change. So 20 rupees, 20% of 12.8 will be our new carrying cost, which will be 2.56, right? So we get a carrying cost of 2.56, and then we will recalculate the EOQ. So we have a units of 5,000. We have the order. Now our orders will also change because we have 5,000 divided by 250 units at rupees 16. Okay, so we get the EOQ. So order cost will not change right now, but our EOQ will change to 250 from 200 units. So this way we have recalculated our EOQ. Coming back to our total cost, here we will have 5,000 units into 12.8, which is our purchase cost. And we have our order cost, which will be 5,000 divided by 250 units, because now we are going to order 250 units. And this will be multiplied into 16 rupees, which will be 320. And again, the carrying cost will be 250 divided by 2, which is our average inventory. And this will be multiplied by our order cost, which has come to 2.5, which is again 320. So our total answer is 64,640. Okay. So I hope everybody has followed till here. Perfect. I can see the right answers. Fiza, that's wonderful. Suraj, great. Perfect. That's perfect. Anybody else? Can you let me know if I'm going too fast or too slow, and if you're following up with me, so that if I need to make some changes, I can do that. Or if you need a break, please do let me know. Shall I proceed? Okay. How about the others? Everybody has got the answers. Okay. Okay. Great. So let's move on to the next illustration, which is a little bit more intense. Same thing, you have to calculate the reorder level, the maximum level, minimum level, danger level, reorder quantities to be calculated on the basis of the following information. Cost of placing a purchase order is 20. So this is your order cost. Number of units to be purchased during the year is 5,000, which is your annual requirement. Purchase price per unit inclusive of transportation cost is rupees 50, which is your order cost. Then annual cost of storage. Oh no, this is not your order cost. This is the purchase price per unit. Okay. Then you have the annual cost of storage, which is your storage cost, carrying cost, which is 5 rupees. Details of the lead time, average 10 days, maximum 15 days, minimum 5 days, for emergency purchases 4 days. Rate of consumption, average 15 units per day and maximum 20 units per day. So whenever you start such questions and there's a lot of information, make sure you make a table like this. You make a table of all the details that is given. So we have our AOC, which is 5,000 units. Just a minute. Yeah. So we have our A as 5,000 units. We have our order cost as 20 rupees. We have our carrying cost of 5 rupees. So we can calculate our EOQ this way. So I'll put it here in our working notes, 5,000 units, 20 rupees at 5 rupees. We'll get an EOQ of 200. I've already put the formula here, which is basically the square root of 2 into AO by C. That gives us 200 units, right? Then we get into the calculation of minimum or consumption. This is all part of your working note. So first we calculated our EOQ. So I hope it's clear till here. Now when we go back to the question, you can see that we have the average consumption and we have the maximum consumption, but we don't have the minimum consumption. So we go back and calculate the minimum consumption. We have average is minimum plus maximum by 2. So minimum will be 2 into average by minimum plus maximum. This will come to 2 into average. Oh, there's something wrong here. So it will be 2 into 15 units divided by there's something I'm missing here. 1 minute. Oh, minus 20. Sorry. My bad. This will be 2 into average, which is 15, minus your maximum amount, which will be your 20 units, which will give us 10. So this is the minimum consumption that we need to calculate. Once we have these missing data, right? So what you needed to see is what is missing here. We saw that the rate of consumption minimum was missing, and then we went ahead and calculated our EOQ. So because these are the details that would be required for us to calculate our reorder level, maximum level, minimum level, and danger level. So let's go into our filling in the amount. So minimum is 15 days, no, 10 days. Minimum is 5 days, sorry. Minimum is 5 days, average is 10 days, maximum is 15 days. So it's supposed to be here. And then we have an emergency lead time of 4 days. So what I'm doing is I'm just filling in the details so that it is easier for us to, and which we just calculated below, maximum is 20 and emergency is not given. Okay. These are the roughly the details that are given. So once you have a clarity of this, we can proceed with calculating for ROL. So ROL, like you know, is we derived at maximum consumption into maximum reorder period. So that should be 20 into 15. That should give you an ROL of 300 units. Is everybody with me here? How about the others? Okay. Then maximum level, I hope you remember the formula, ROL minus minimum consumption into minimum reorder period plus EOQ. So that would be ROL plus What is your minimum? 10 into 5 minus plus QQ. So that should come to 450 units. Good job, Preserve. Good job, everybody, with the answers. Rania, Preserve. Then calculation of minimum level will be ROL minus normal. What is it? The average consumption into average reorder. So this should be equal to ROL, which is your 300 minus average consumption, which is 15 into lead time of 10 days, which comes to 150 units. Everybody following till here? Okay. Now coming to danger level. Danger level is something where we will not be considering any danger consumption. In a case of a danger level situation, we are basically going to see, in case of an emergency situation, how much would you want to keep in stock. So again, we will be considering a normal consumption, an average consumption, not maximum, not minimum, because it's a danger situation. We don't know what we could expect. So at least an average level is what we are expecting. So it will be an average consumption into the danger lead time or the danger reorder. So this would be our average consumption, which would be 15 units into our emergency lead time, which is 4 days. That gives us a 60 units of items that need to be kept in case of a danger level, right? So everybody clear about how to calculate this, the logic behind calculating this, and why are we calculating this? Any questions? Anybody who's stuck with the calculation, please, if required, let me know what's all clear. Okay, perfect. Now coming to illustration 5. So before that, so this was about reorder level, inventory, maximum level, minimum level, etc. Because this is what you require for your keeping a control over your inventory, to know when to order, how much to keep, beyond which you don't want to go, and under how much you don't want to keep. So this is how you understood like how to keep a control over your inventory. The next is your inventory stockout. Inventory stockout basically means the demand of an item that could not be fulfilled because of insufficient stock level. Now, insufficient stock level happens because you would have had an inventory that you would have had to keep, but because you did not order it on time or because the amount was not available with the supplier, you were not able to have that amount with you, and that led to a stock out. And when it leads to a stock out, definitely you're going to lose out on sales, which is not what you want. So you have something called as a safety stock that you keep. Just like I mentioned during the ROL formula, there's a minimum amount of safety stock that you need to keep so that you don't lose out on the the crucial sales that suddenly might come up. So there is a buffer that you keep, a cushion that you keep against unexpected demand for that item. While deciding on the level of inventory, a trade-off between the stock out cost and the carrying cost is made so that the overall inventory cost can be minimized. So what you need to understand is that whenever you're calculating how much safety stock to keep, you should make sure that you are calculating your stock out cost as well as your carrying cost and seeing that you are able to make a good trade-off between the two. So what is stock out cost? Basically, when you don't have enough stock and you're losing out on sales, that loss of amount is called a stock out cost. And carrying cost is when you're keeping or holding that safety stock with you. you have to, pay for that amount for carrying that inventory. So that is called your carrying cost. So whatever you can, if your stock out cost is high, definitely your carrying cost would have been low. If your carrying cost is high, stock out cost. So we have to see how we can maintain this right balance so that both of them are at the lowest. So let's look into one question here now for your stock out cost. I've got a question. Is it necessary to present answers in these columns? Definitely presentation makes a difference, but when you're writing it in the exam, you'll be like, you'll not have time. So it's best to make sure that it is neatly, you've presented it neatly so that the person who is correcting your paper is aware of what amounts have been put there. If you're not able to put the columns, it's fine, but presentation has to be very neat so that they can understand what you're trying to show or express in the answer. I hope that answers your question, Jamsina. Okay. So now we have something called as the stock out, safety stock. How do we decide how much to maintain? So let's look into this question. Messy Tyro Tubes trades in four-wheeler tires and tubes. Trades in four-wheeler tires and tubes. It stocks sufficient quantity of tires of almost every vehicle. In year-end 22 to 23, the report of sales manager revealed that Messy Tyro Tubes experienced stock out of tires. The stock out data is as follows. So 100 tires had stocked out twice, 80 tires had stocked out 5 times, 58 tires had stocked out 10 times, 20 times, 10, 30 times, and 0, 33 times. Messy Tyro Tubes loses 150 per unit due to stock out, which means it is a sale lost, and spends 50 rupees per unit on carrying of inventory. Determine optimum safety stock level. So now what you need to understand is we are calculating something called as the safety stock. So this is how your table will have to be presented when you're calculating how much safety stock is to be identified. So we know that, let me go back. So these are your stock out of tires, correct? And these are the number of times the stock out happens. So number of times will have to be converted into probability. So the first step we will do is we will convert this number of times into probability. So we have our stock out units. We'll just copy this from the question: 100 units, 80 units, 50, 20, 10, and 0. So this is roughly what the client generally gets stocked out of. So sometimes it would have needed 100 units, but all 100 units will not be there. Sometimes it would have needed 80 units, but all 80 units would have not been there, 50, so on and so forth. And how many times it has happened? For 100 units twice, for 80 units 5 times, for 50 units 10 times, for 20 units 20 times, for 10 units 30 times, and for 0 units 33 times. So if you look at the total sum of this, it comes to 100. Okay. So now we can calculate the probability, which will be 2 by 0.2. Is everybody following? Let me know if there's any confusion. So we will just copy paste this formula, and this will be our probability. So there is a probability of 20% of the times that 100 gets stocked out. Oh, sorry, 2% of the time, 5% of the time, 10%, 20%, 30%, and 33% of the times that these stockouts happen. So we are just making it in a probability form. Now we will compute what is the stockout cost and inventory carrying cost for each safety stock level items. So the first is 100 units, right? We want to see if maintaining 100 units as a safety stock, because you're losing out twice on 100 units, whether maintaining 100 as a safety stock would be ideal or not. What is the stock out unit that will happen at 100? That would be 0, because the total amount that is needed is 100, right? So there is nothing that will be stocked out if you keep 100 units. What is the probability that the stock out will happen? So you have to go like this. So if you can see, stock out of 0 will happen when there is an inventory of 100 units, correct? So here we can see that the probability is 33%. Stock out of 20 will happen when there is 80 units in hand. Stock out of 50 will happen when there is 50 units in hand, 20 units in hand, and 0 units in hand. Right? So let's come back to our sheet right now. So at a safety stock of 100, your stock out units will be 0. And if your stock out units is 0, your probability is over here to be 33%. So we will just put that here. Stock out costs. Now, because there is no stock out, so definitely stock out into 150 rupees, which is our stock out cost, will come up to 0. What is your expected stock out cost? Which is stock out cost into the probability of stock out, which is again going to become 0. Then we have our inventory cost, carrying cost. So that will be the amount of units that we are maintaining into our 50 rupees. That will give us 5,000. So the total cost that we have of maintaining a safety stock of 100 units will be carrying cost plus our stock out cost, which comes up to 5,000 rupees. So what you need to understand here is three concepts. One, when you are maintaining a safety stock, a buffer, how much stock out will you face? So you are maintaining the maximum amount. So here there is no buffer that you will, there is no stock out that you will face. What is the probability of that stock out you will face? What is the stock out cost that you will incur of, losing out on that stock? What is that expected stock out cost? Because you're not going to lose out on that amount every time. It is only 33% of the time that that stock out happens. So that is the expected stock out cost. Then you calculate what is the cost of carrying that safety stock, which is the cost of carrying these 100 units is 5,000. And then you add up the 2 points, which is your inventory carrying cost as well as your expected stock out cost. This together will give you a total cost of holding that safety stock level. Am I clear till now? Okay, let me present you some more amounts. Maybe that will make it more clear for you. So let's go into the second one, which is 80 units, which gives you a stock out units of 20. When you look at stock out units of 20, which is this, it is having a probability of 20%. So, okay, so before that, right, now we will look at what is the stock out cost, which is the 20 rupees into 20 units into 150 rupees. So you will have a stock out cost of 3,000. But this stock out will happen only 20% of the time. It will give you a 600 rupees of expected stock out cost. Then we have an inventory carrying cost of 80 units into 50 rupees. That will give me a total amount of 4,000 plus 600. Is this clear? Is everybody following? If there's any questions, you can just put it in the chat box. I will try to clarify the question. Okay, thank you for the response, Rania. Anybody else? Is everybody following? Okay, Ashmal, thank you. Okay, let me go into the next one. Maybe this will give you more clarity. So we have a safety stock level of, let's now say, 50 units that we want to maintain. If we are maintaining a safety stock of 50 units, there is a probability of either having a stock out of 50 units, that is when the demand is of 100 units, or they could be a stock out of 30 units when the demand is 80 units. Because see, this is the demand that we are having, right? Either of 100, of 80, of 50, of 20, of 10, or 0. How did we come at this? From here, right? So this is the stock out that happens. So this is the demand that we could have at any given point of time. So when you have a demand, when you are having a safety stock of 50, what are the different demands you could have that you cannot meet with is probably a demand of 100 units where you will have a stock out of 50 and a demand of 80 units where you have a stock out of 30. So what is the stock out probability of 50 units? Of 50 units is going to be 1 minute. Yeah, so it will be of 50 units will happen when the demand is of 100 units. So that will be 2%. And of 30 will happen when there is a demand of 80 units, which will be 5%. So here we'll have a stock out cost of 50 units into 150 rupees and 30 units into 150 rupees, which is 4,500. What is the expected cost? We'll go into 7,500 into 2%. Similarly, 4,500 into 5% will give me 225. So the total cost here is 375, and inventory carrying cost will be 50 units into 50 rupees, which will be 2,500. So my total cost will be 375 plus 2,500, which is 2,875. Is everybody following? Okay. So we'll proceed with the next one, which is 20 safety. So when you're maintaining a safety stock of 20 units. So when we are maintaining a safety stock of 20 units, there could be a situation where you could have a stock out of 80 when the demand is 100. Could be a stock out of 60 when the demand is 80, and there could be a stock out of 30 when the demand is 50 units. So what is the probability that the stock out of 80 would happen? That's when the demand stock out is 100. So that's 2%. 60 would happen when it is 80, which is 5%. And 30 would happen when it is 50, which is 10%. So similar calculations will happen into 150, 12,000. And this gives a total of 25,500. The expected probability would be into 2%, 450. It would be 20 units into 50 rupees, should be 1,000. So my total cost will come to my carrying cost plus my expected stock out cost, which is 2140. Repeat the same process for 10 units. So 90 stock out cost happens when there is 100. 70 will happen when there is 80. 40 will happen when there is 50. 10 will happen when there is 150 rupees. Expected will be this into 50%. carrying cost will be, 10 into 50 rupees, which is 500, equal to 500 plus my stock out cost, which is 2195. And then there is a last one where you're maintaining a safety stock at 0. So you will place all sorts of stock out here for the total 100, for 80 units, for 50 units, for 20 units, and for 10. So we will put in the probability. 100 units will happen 20% of the time. 80 will happen at 5%. 50 will happen 10%. 50 will happen 20%. 10 will happen at 30%, right? So here we have to 150 rupees, everything into 150 rupees. Then we calculate the expected, which is into 20%, 30, and this is the sum of the total expected carrying cost, stock out cost. And this would be 0 into 50 rupees, which is again 0. Your total cost to carry would be plus the expected stock out cost would be 2,700. Yes, I know this is quite a time consuming process, but it's important to just understand the concept. The concept is to calculate what is the probability, what is the expected stock out cost, and what is the inventory carrying cost that you will have in order to calculate what is the optimum level of safety stock. So now you have this table in front of you. You can see that when you're having a safety stock level of 100 units, you had to maintain your cost is coming to 5,000 rupees. When you have a safety stock of 80, you have a cost of 4,600. When you have a safety stock of 50, you have a cost of 2,875, so on and so forth. So how will you calculate what is the optimum level of safety stock? From here, it will be the least amount of total costs, which in this case is coming to 2140. So 2140 will be your optimum level of safety stock, and that is something which you will consider for your optimum safety stock level. So you will maintain 20 units as your safety stock level. So after calculating this table, you check which is the lowest in the total costs, and then you will calculate your safety stock level units, which comes to 20 units. Is it clear till now? I know this was a little bit, you can say, time consuming and requires a lot of just calculations. There's nothing that, you need to put in some formulas or anything. It takes some time. But once you practice more of these questions, you will get a hang of it and you will be able to identify this. So the basic fundamental here is to find out which is the least of the total costs of inventory plus expected stock out costs. So I hope that is clear. And anyway, there's only a few illustrations on these. So most likely this will not be a major question, but it's good to always practice it and have an idea of how to do it. So let's move into our next question. The next topic, which is ABC analysis. Now, what is ABC analysis? ABC analysis is basically to categorize your inventory into most important, moderately important, and least important. So to give you an example, when you enter into a electronic store, so there is a whole different chapter for ABC analysis, but just to give you a brief about what ABC analysis is, if you enter into an electronic store, you will find out that there are TVs, laptops, etc. in one side, and then there is also your laptop bags or sockets or small pieces, chargers, etc. in one side. And then there are like small, moderately sized items like juicers or mixies, grinders, etc. So you can see that the price range for each item is deteriorating consistently. Like a TV will definitely be highly priced. A juicer will be moderately priced, and the laptop bag will be very low priced. So what an organization needs to understand is how it can categorize each of these items based on their importance. If a TV and a laptop bag is given the same kind of importance, it is detrimental for the company, because the laptop bag, even if one or two, let's say, get lost or stolen, the cost to the company is not as high as a TV would get stolen from the showroom. So the security controls that will be put on checking whether the TVs are in or are safe or not will be much higher than the security controls that are put over a small costing bag. So this is how you categorize ABC. A should have better control, B should have moderate controls, and C will not need to have any constant controlling over it, because they are not that uh, highly invested, and it's not of high value items. So that is how, and that is the reason behind why you segregate ABC items, to understand what requires more of your attention, what requires more of your controls over these items. So let's go into one question which is there in the illustration in the study material. So here we can see that there is a list of items that are given. So probably an item which, the company is having, the number of units that this company is having, and the unit cost for each item, right? So now, in order to be able to set up an ABC plan, which is basically ABC analysis, you will have to use a judgment of what you want to place under A, what you want to place under B, what you want to place under C. So here we can give an assumption that anything that goes above 50,000 rupees. This is an assumption that you and me will make at the time of answering this question in the exam. So anything above 50,000, we can put it under A. Anything like between 10,000 to 50,000, we can put it under B. Maybe anything under below 10,000 would come under C. So this is just an example I'm giving you as to how to approach this question. So let's go into the illustration now. After this, we can just take a quick 5 minutes break if you all want. Maybe it might be getting too much for you. So after this question, we'll just take a quick 5-minute break and we can be back. Yeah. So let's just finish this question. So as per the question, there are 12 items. So the first item has 7,000 units. The second item has 24,000 units, 1,500 units, 600 units, 38,000 units, 40,000 units, 60,000 units, 3,000 units, 300 units, 29,000 units, 7,500 units, 4,100 units. So these are the number of units that have been defined in the question, coming to a total of 219,000 units. Oops. Now we can take a percentage of units. So that will be nothing but divided by 1 we can just convert this into a percentage. This is coming to 11%, 1%, 600%, 17%. Just copy paste formulas. So this should give you a total of 100%. So this is just our way of bifurcating and understanding what are, what is the total number of units belonging to each item. So you can see that we have calculated the percentage of U. When you get into unit cost, so this is what is given in the question. This is for 5 rupees, this is for 3 rupees, 10 rupees, 22 rupees, 1.5 rupees, 0.5 rupees, 0.2 rupees, 3.5 rupees, 8 rupees, 0.4 rupees, 7.1 rupees, 6.2 rupees. So we get a total cost of 7,000 units into 5 then 72,000, 15,000, 13,000, 57, 12,000, 1,500, 2,400, 11,600, 81,650, and 25,420. We can see that we have a total cost of all the units in the in their warehouse to come to 3,55,770. Now we will calculate a percentage of the total cost coming to 10%, coming to 20%, 4%, so now we can do a ranking based on the percentage of the total cost. So we can see that the highest cost is here. So basically something like our TVs, which is the most expensive in the showroom. Then this is second. This is our third. This comes to fourth. This comes to fifth. This comes to sixth, 7, comes to 8, comes to 9, 11, 12, done. So you can see that we have been able to rank our units based on the total cost that is allocated to that particular unit as a percentage of the whole. So this will help us analyze and bifurcate how to segregate the items into our ABC method. So like I said, we can see that, this is all based on our judgment. I am randomly taking 50,000. So if you see like anything above 50,000, we can say it is, to be classified as A. Anything between 15,000 to 50,000 can classify it as B, and anything below 15,000 can be classified as. So these are the assumptions that we are making for our ABC. So now how do we implement this ABC plan? So we have one. So these are the items we can see above 50,000. So we can highlight them as yellow. Then these are the items which are between 15,000 to 50,000. And the rest we can put it as below 15,000, which is our category C. %, 17%, and cost coming to 1,000, 57,000, 160. This will be our A, classification of A. Then we have which is our green color, 5, item number and 12. Percentage of units, 3 in 25. Total cost comes to 35, 20, 25. So here we have 34% of the items are coming under A, 24% is coming under B. Then we start with C, which is 8, 9, 10. The last one. Okay. Again, this was also a time-consuming question, but roughly the idea is to make you understand how you can bifurcate items into categories of A, B, and C based on their cost and their total units. So this is how you can calculate this question and perform this answer in the exam. It's a very simple question. If you get something like this in the exam, it's a no-brainer. You can really fetch your marks in this question, but it's just about knowing where to put what item and how to segregate it. And this is all an assumption you make of what you want to categorize in category A and what you want to categorize B or C. That's all upon you. So this is how you will calculate it. So I think let's just take a quick 5-minute break. The time now is 4, I think it's 3:55, right? India time. So I think let's meet at 4, if that's okay. And then we'll continue. You can just refresh yourself for 5 minutes and then we resume in 5. Yeah? Okay. So see you in 5 minutes. Yes, perfect. Hello, everybody. Is everybody back? I just see Ranya's thumbs up. How about the others? So now we just have a few more things to cover. We'll quickly wrap it up in another 1 hour and we'll try to close material costing for today. So let me share my screen. Yes, I hope everybody's back. I can see the thumbs ups. Let me know if you can see it. Okay, perfect. So just a few more topics now, and then we'll be done with the session. Resuming with our inventory turnover ratio. Inventory turnover ratio, in simple words, just means how fast you're consuming your inventory. If you're having, like, let's say you have put a stock of 500 units to be held during the year, but you have only utilized 250 units during the year. So your inventory ratio can be determined by dividing the cost of materials consumed divided by the cost of average stock held during the period. So that is your inventory turnover ratio. Now, average stock, it's pretty simple. It's your opening stock plus closing stock divided by 2. And then you have the average number of days you have held the inventory for. So if you have calculated your inventory turnover ratio for on the basis of like, let's say, months, then you will divide your average number of days the inventory will be 12 months divided by inventory turnover ratio. If your inventory turnover ratio is calculated on the basis of days, then you will take 365 days divided by your inventory turnover ratio. So this is roughly the formulas you need to remember. It's very simple. Turnover ratio is like how much fast your inventory is basically turning around. So if you had 500 units held, 200 units, 250 units have been consumed. So a 50% of the turnover has been, inventory has been turned over. So you have utilized 50% of the inventory. So that is what an inventory turnover ratio is. So let's quickly look into our illustration for inventory turnover ratio. This is a very simple one, something you've been doing since 12th grade. So we can quickly read the question. Just a minute. Just give me a minute. Yeah. So we can read the question. The following data are available in respect of material X for the year ended 31st March 2023. Opening stock is 90,000, purchases is 2,70,000, closing stock is 1,10,000. Calculate inventory turnover ratio and the number of days for which the inventory is held. So now we can see that we have opening stock, we have purchases, and we have closing stock. So what we need to calculate now is the goods that have been consumed. So let's move into our illustration working and look at the first one, which is the calculation of the goods consumed. So we have our opening stock, which is coming to 90,000 units. Then we have our material purchased, which is 2,70,000 rupees. Then we have our closing stock, which is 1,10,000. Oops, 1,10,000. And this is 2,70,000. Perfect. I see the right answer already. So that is our opening plus our material purchase minus our closing stock. Oops. Opening plus purchases minus our closing stock, which comes to 250,000. So this is what you need to get for your cost of goods consumed. Now, calculation of average inventory is your opening plus closing divided by 2. So what is your opening and closing? Opening is 90,000. So that will be 90,000 plus 110 divided by 2. So what is your inventory turnover ratio? It is your consumed by the inventory held. So that is your 250 by average inventory, which is 2.5. That gives you your inventory turnover ratio. Average number of days the inventory is held for will be your, because like you see, this is a data given for the year and we need to calculate it for the number of days. So in a year, the number of days is 365. So that will be 365 days divided by our inventory turnover ratio. So roughly our inventory was held for 146 days. So this is a very simple concept. You just need to remember a few formulas. It's not even to be mugged up. You can completely understand inventory turnover ratio. Then you have your average number of days the inventory is held and the average inventory. These three formulas, if they are clear, you can definitely come down to the answer and resolve it. Shouldn't be an issue at all. So that's it, just one illustration. There is a few more questions in the study material. I'm sure you will be able to answer them. They are not that difficult. So you should be able to answer this if you have understood the concept right now. If any questions, please do put it on the chat box. I will resolve it right away. So moving on to the next part, which is our cost price methods. What is cost price methods? So I'm sure you have learned this during your foundation or your first level of CA, where different types of cost methods are there: LIFO, FIFO, and your weighted average cost. LIFO is something where when you are calculating the cost for the item, the cost of the inventory or the cost of the unit is based on the last item that is purchased. So this is last in, first out. FIFO is when you buy a particular item and you value it at the cost at which you had purchased that inventory first. So that is first in, first out. Weighted average cost, you take the total of whatever you are having in hand divided by the total number of units and you get your weighted average cost. So, of course, this is just in theory. We will definitely resolve a question so that you're able to understand this better. So what does this question say? That the following information is provided by Sunrise Industries for the fortnight of April 2023. Material X, stock on 1st April 2023, 100 units at 5 rupees per unit. Purchased on 5th April, so many units at rupees 6. 8th April, 500 units at rupees 7. 12th April, 600 units at rupees 8. Issued on 6th April, 250 units. 10th April, 400 units. 14th April, 500 units. What are you required to calculate using FIFO and LIFO methods? The value of materials consumed during the period, the value of stock of materials on the 15th of April, which is the last day, and then explain why the figures in A and B in part A of this question are different under the two methods of pricing. So let's go ahead and resolve this question. So we will calculate the value of X using the FIFO method. So we can see that in the question on 1st April, it is said that we have an opening balance of, we have an opening balance of 100 units at the rate of 5 rupees. So this is equal to 100 into 5 rupees. So this is our opening balance, which is given in the question. On 5th April, we have purchased something which is 300 units for 6 rupees. That will give me a total value of 6 into 300 units, which is 1800. Then on 6th April, what is happening is there is something that is being issued. You'll see in the question for 250 units. Now, the thing is, we are using a FIFO method. So what is the cost at which you will issue these units is what has come in first. So the first 100 units will go for 5 and the remaining 150 units of the 250 units will go for 6. So we will bifurcate the 250 units as 100 units and 150 units. 100 units will go at 5 rupees and 150 units will go at 6 rupees. So this will be equal to 100 into 5 and 150 into 6. So a total of 1,400 rupees. Now, on 8th April, again, we have made a purchase of 500 units, which will go at 7 rupees, which is 500 into 7 rupees, 3,500. On 10th April, we are making an issue of, if you see, we're making an issue of 400 units. Now, how do we calculate the 400 units? The 100 units have already been gone. From this 300 units, we have already given 150. So we have 150 left from here. So the 150 units will take from this, which is at 6 rupees. Oops, which is at 6 rupees. And the remaining, which is the 400 minus 150, which is 250 units, we will take it from the next purchase, which is at 7 rupees, 7. So that will give me 1,750 plus 900, which is 2,650. Next, 12th April, again, we have made a purchase of 600 units at 8 rupees. That is a 4,800 rupees. On 14th April, we have made an issue of 250 units at, okay, so not 250 units. We have made an issue of 500 units. But out of the 500 units, now you know 100 is gone, 300 is gone. Out of this, we had given 250 units. So we still have 250 from here. So for the 500, we will take 250 from this bunch, which is at 7. And the remaining 250, because we have issued 500 units. So the remaining 250 units will go from this bunch, which is at 8 rupees. That gives you 2,000 rupees. So that is 3,750 rupees total. Then we calculate a balance here. The balance will be of, if you see, let's remove this issue of, so 100 is gone, 300 is gone, purchased 500. So we had taken 250. Again, we took a 250. And from the last 600, we had issued a 250. So we have a remaining of 350 valued at 8, which will be 2,800. So this is how our cost sheet will look like in terms of the FIFO balance. First in, first out. I'm not getting into the details of this because I'm sure FIFO and LIFO are something everybody must have been aware of, right, in the foundation level as well. So please let me know if you need any clarity here. I will explain it further, but this is how the FIFO method of cost calculation will take place. So if we just have to add it, we will add on 6th April, we had a total consumption of 1,400 rupees. On 10th April, we had a total consumption of 2,650. On 14th April, we had a total consumption of 3,750. So that is a total of 7,800 units being consumed. Now, the second part of the question is to value it using LIFO method. So in LIFO method, it's pretty simple. Last in, first out. So again, we start with the opening balance of 100 units at 5 rupees, which will give me 5 into 100. Then we have a purchase made, which is of 300 units at 6, which will be 6 into 300. On 6th April, we make an issue. Now, here the thing is, we don't do first in, first out. We do last in, first out. So the last that thing had come was at rupees 6. So we will remove this also at rupees 6, which will come to 1,500 rupees of issue. Then again, we make a purchase of 500 units at 7 rupees. That comes to 3,500 units. Then on 10th April, we make an issue of 400 units. Now, since we are going for last in, the last that had come in was at 7 rupees. So we will rate this at 7 rupees, and that will be a 2,800 issue. Then on 12th, again, we have made a purchase of 600 rupees, 600 units at 8 rupees. It will come to 4,800. On 14th April, we made an issue of 500 units at 8 rupees, which is coming to 4,000, because this is last in, first out. So the last item had come in at 8 rupees. So we will be considering this issue of items at 8 rupees itself. And then finally, we look at our balance, which will be 350 units. And this will be so let's make this easier to understand. Issue is minus we have a balance of 2,300. So here, if you look, on 6th April, our consumption is coming to 1,500. 10th April, our consumption has come to 2,800. 14th April, it has come to 4,000, or total consumption of 8,300. You can see the difference here. When we calculated it in the FIFO method, our total consumption came to 7,800. And when we calculated in the LIFO method, our total consumption came as 8,300. So what is the reason for this difference in the cost of FIFO versus LIFO method? So the quantity used for both is the same. We have consumed 250 units on 6th April, 400 units on 10th April, and 500 units on the 14th April. The value using FIFO method is coming to 1,400, coming to 2,650 and 3,750. So I'm just picking these values from here, right? And then when you look at the value using LIFO method, let's take this. And let's take this as FIFO, right? When you take the value using LIFO method, you will have a unit of 100, just let me take the sum of the total as per FIFO method is coming to 7,800, and the sum as per LIFO is coming to that we have already arrived at. So what I'm trying to show you is why there is a difference between FIFO and LIFO, because when on 6th April we purchased the 250 units, under FIFO method it was valued at 1,400, but under LIFO it was valued at 1,500 because of the difference in the type of valuation, and so on and so forth for the 10th April issue and the 14th April issue. And this is the reason behind the difference between that 500 rupees that has come between LIFO and FIFO method. So when you are answering this question in the exam, if they ask you to explain the reason of the difference, you can just put this table and you can explain how there is a difference between the values under FIFO and values under LIFO. So this way you can conclude this point. Is the question clear till now? Let me know if there's any doubts with this question in the chat box. Is there any doubts? All clear? Okay, Rania. How about the others? Okay. So this is how you will proceed with FIFO and LIFO questions. Coming to the next part. This is a fairly important point, which is the difference between normal losses and abnormal losses. So it's very natural that when you are doing your, you're doing your material costing, when your materials are coming in, like I mentioned, there could be normal reasons for the evaporation of petrol and oil, or there could be an abnormal reason because you did not save the ship well, there was a demurrage, there was some accident, there was some mishap that caused the spillage of the item. So this is, I'm just giving you an example of a container coming in with your material. So this way you can differentiate between a normal loss and an abnormal loss. What you need to just remember here is that if it is a normal loss, your normal loss will be absorbed into the costing of the goods, just like we did in the previous question. But if it is an abnormal loss, then that difference has to be transferred to the P&L account because it cannot be absorbed in the cost of goods. It's not the responsibility of the item that the goods, there was a defect or there was a loss in the items or inventory. So this has to be very, very careful. You have to be very aware of how to treat the abnormal loss and how to treat the abnormal loss. So this is the main part. You need to know that a normal loss has to be absorbed into the good units and the abnormal loss has to be transferred to the costing P&L. Okay. So how that happens, we will perform a question right now, and this should clarify your doubts about. So let's look into this question now. Embryos India Limited is recently incorporated startup company back in the year 2019. It is engaged in creating embedded products and Internet of Things solutions for the industrial market. It is focused on innovation design, research and development, products and services. One of its embedded products is LogMax, a system on module carrier board for industrial use. It is small, flexible and embedded computer design as per industry specifications. In the beginning of the month of September 2022, company entered into a job agreement of providing 4,800 LogMax to NIT, Mandi. Following details with respect to issues, receipts, returns of store department handling microcontroller, a component used in the designated assembling process have been extracted for the month of September 2022. So let's look into this. There was an opening stock of 6,000 units at 285 per unit. There was an issue of 4,875 to the mechanical division. There's a receipt of 17,500 at 276 rupees. Issue, return to stores, receive, return to supplier, issue. So basically, this is just giving you a detail about what took place during the month. On 25th September, the stock manager of the company expressed his need to leave for his hometown due to certain contingency and immediately left the job the same day. Later, he also switched his phone off. As the company has the tendency of stock taking every end of the month to check and report for the loss due to rusting of the components, the new stock manager on 30th September 2022 found that 900 units of microcontrollers were missing, which was apparently misappropriated by the former stock manager. He further reported loss of 300 units due to rusting of the components. From the above information, you are required to prepare the stock ledger account using weighted average method of valuing the issues. Okay, so a lot of content, you don't need to look into everything because the question will have lots of information. But according to me, what is the main question and main concept in the question is this table. This table is very important to read and understand what has come in, what has gone out. And in this second part of the question, there is something where he's telling about an abnormal loss. So on 30th September, you can see that 900 units of microcontrollers were missing, which was apparently misappropriated. So when you say misappropriated, this is not a normal loss. This will not be absorbed in the good units, and this has to be transferred to the costing P&L. And when you further reported a loss of 300 units because of rusting, rusting is not something that has happened due to a human intervention. It is a normal thing that goes on. It's a normal obsolescence of the inventory, and therefore this should be treated as a normal loss. The more important part here is that we are going to be calculating using weighted average. So I hope you've understood a rough brief about the question, what is going in, what is coming out, and what is the normal loss and what is the abnormal loss. Please do take the screenshots, and you can also start working out on the sum. Simultaneously, I will also be looking into the sum here. So this is how we will be presenting it. So we have our date. So we are going to be calculating the weighted average cost of the inventory item. We have the date of when this inventory is coming in and going out, the receipts, the issues, and the value. This is roughly how you will present a weighted average cost sheet. Above sheets that I had shown was with respect to LIFO and FIFO, but when you do for a weighted average cost, this is how the presentation should generally be done. Okay, so let's start with the answer. Just a minute. Okay. So let's put in the dates first. September 1st, September 8th, September 9th, September 10th, September 12th, September 15th, 17th, 20, 30, and 30 again. So this is nothing. I'm taking it right from the question. I hope. Okay. Can you show the question once more, please? Yes. So this is the first part. This is the second part. And this is the third part. Is this okay? Okay. Everybody else can also do the same. Like you can just take a screenshot and start solving the question however you can, or you can follow along with me as I'm doing it in the Excel sheet. Okay. I hope this method is fine. If you feel like, this is not something you are able to follow with, please let me know. I will make some changes for sure. Okay, so let's proceed. I've put in the dates from the question here. Let's start with the receipts, issues, and balance. Receipts. 1 minute. I'll just put this a little aside. So on September 1st, there was no receipt as such. There was only a balance of 6,000 opening balance units at the rate of 285, which amounts to 6,000 into 285. Okay, so that is how the first part of the question will be resumed. Then on the 8th of September, there was an issue of 4,875 units. So when there is an issue of 4,875 units, the issue will always take place at the rate at which your balance was previously held, because this is a weighted average cost. So whatever was previously held will be the amount. So we will take the same value of 285 units and calculate the amount at which these units have been issued. That is coming to 13,89,375. So what is our balance now? 6,000 units minus 4,875, which is 1,125. And then you will have a balance here of 17 lakhs minus 13 lakhs of 3,20,625. And your rate is calculated by dividing your amount with the quantity. So that will give you 285. There will be no change in the rate because you have issued the amount at the same rate. So your rate remains the same. But the important part at weighted average cost is to always remember this calculation. So let's proceed further. On the 9th, we've had a purchase of 17,500 units at 276 rupees. So that comes up to 17,500 into 276, which is 48 lakh 30,000 units. So when we come back to our balance, we will have 1,125 plus 17,500 units. We will have an amount of 3 lakh plus 48 lakhs, coming to 51 lakhs, which will give us a new weighted average cost of 276.54. Is everybody following with me about how the rate is calculated here? Okay, how about the others? Okay. Any questions so far? Okay, so I'm assuming that the students have understood. Then again, on the 10th of September, we have an issued quantity of 12,000 units, and this have been issued at this rate. So as I always told you, the issue will always happen at the previous rate, which is basically your balance, your closing balance rate, because that's how weighted average cost is calculated. There's no FIFO LIFO here. So that into 276.55. So the balance will be 18,000 minus 12,000 5 lakh minus 30 lakh, which will give you a weighted average cost of 276.54. That will not change. On 12th September, there has been a purchase of 2375 units at 276.54. 76.54. Okay. So let's go back to the question here. It says returned to stores 2375 units by the technical division. It doesn't really tell at what rate they have returned it. And for this very reason, when something is being returned from an inter-department or an inter-store transfer, it will always happen at the weighted average cost itself. When you go back to this question, you can see that 276.54 is nothing but the cost, the weighted average cost itself, because this is a return. It is not a purchase, it is a return. So the return will happen at the weighted average cost itself. Here we will calculate the quantity into the rate, which will give me 6,56,000. My issues will not be affected. My balance will become 6625 plus 2375, which will go to 9,000. My total amount will go back to 24 lakhs, and the total balance will come to 270. Total weighted average cost will be 276.54. There will be no change there because your purchase has happened at the same rate. On the 15th of September, there was a purchase of 9,000 units, and these 9,000 units took place at 288 rupees. So this will be 9,000 into 288. So I will give this an addition, 18,000. There is a total added value of, and the amount will be divided by quantity, giving us a revised weighted average cost of 282.27. So this is how it will be calculated. On 17th, what has happened? We have issued 700 units. Now, when you go back to the question, it says returned to supplier 700 units pertaining to 160.22. Now, generally, when you're issuing something or removing something from your store, it is always supposed to take place at the weighted average cost. However, here we are returning it to the supplier. Whenever you return something to the supplier, you will return it at the same rate at which you have purchased. So go back to the purchase rate of 162, which is 288 rupees. So when you go back to your cost sheet, you will not be applying 282.27 here. Instead, you will be applying 288, which is the cost at which you had gotten it from the supplier, because that is the rate at which you will give it back to the supplier. So 700 into 288 rupees, which is 2,16,100, which will give me a total quantity of 17,300, a total price of 4,879, which will give me 282.04, which is the new weighted average cost. Now, next, we have issued a 9,500 units to the store. This will take place at the weighted average cost itself. So this will be 1,500, 26,79,000. This will be there will be no change. It will be 282.04 itself. Now coming to 30th September, which is the important part in this question. When you go back to the question, like I said, 300 units were due to rusting of components and 900 units were due to misappropriation. So we have clarified here, 900 units have gone because of an abnormal loss, 300 units have been gone due to a normal loss. So how do we treat the 900 units, which is an abnormal loss? Now, abnormal loss, like I said, will be transferred to the costing P&L, right? So when something is transferred to the costing P&L, there will be a cost to it. So at what cost will you be transferring this to the costing P&L? At the weighted average cost itself. So 900 units will be transferred at 282.04, and this will be going to the costing P&L separately as an abnormal loss. So when you will see your annual weighted average cost, that should be more. It will be at 288.04, 282.04. But you have to remember that it is it's an abnormal loss. So it will be transferred to the costing P&L and there will be a cost to it, which is calculated at the weighted average cost. However, the 300 units that were lost will not be transferred anywhere. It will be absorbed into the cost of the existing inventory items itself. And how is that done? If you remember, we will just be reducing the existing items with the normal loss unit and arrive at the actual inventory items. Then divide. Then we will have the exactly same amount. The value will be the same because there is no transfer to the costing P&L. The existing amount is going to be absorbed into the inventory item. So the weighted average cost will get inflated because the cost of those 300 units is getting absorbed into the cost of the existing items. So this is something which is very important and critical to understand from a point of view of normal loss and abnormal loss. So you can see there is a transfer of cost that has come here, which will go to costing P&L, and the 300 units will not have any costing impact. It will just inflate the weighted average cost. There will be no journal entry passed here. In the system, the weighted average cost will just be increased because we have reduced the existing quantity of goods and we have increased the weighted average cost of the unit per unit item. So this is how the loss gets absorbed into the units. Is everybody clear with this concept of weighted average cost, normal loss, and abnormal loss? Is there any questions? Is there something you want me to repeat or make you understand again? Okay, thank you, Rania. How about the others? Okay, Priya, thank you. Riza, okay, Shahala, thank you. So I can see that there is clarity and everybody has understood this concept well. Okay, perfect. This is how you need to present this question in the exam as well in terms of normal loss and abnormal loss. So once the concept is clear, you can definitely apply it however and come to the final answer. So now coming to the next question. So these are questions. So now I can clearly say that all the practical concepts have been covered. We have covered most of the practical concepts, and you can now, for all these concepts, you can focus on solving your RTPs, your MTPs, and you should be able to attempt those questions easily. There shouldn't be any issues. So I have just picked a couple of questions from like past papers, etc., so that we can just solve them in the class and see whether there is an understanding of the concepts or not. So I would like you all to solve this question as well along with me. So let's look into the question. The quarterly production of a company's product, which has a steady market, is 20,000 units. So please note, it is a quarterly production. Each unit of a product requires 0.5 kg of raw material. The cost of placing one order for raw material is 100 rupees and the inventory carrying cost is 2 rupees per annum. The lead time for procurement of raw material is 36 days and a safety stock of 1000 kg of raw material is maintained by the company. The company has been able to negotiate the following discount structure with the raw material supplier. Order quantity kg discount rupees. So if he's ordering up to 6,000 kgs, there is no discount. Between 6,000 to 8,000, there is a 400 rupees discount. Between 8,000 to 16,000, there's a 2,000 rupees discount. 16,000 to 30,000, 3,200. 30,000 to 45,000, 4,000 rupees discount. You are required to calculate the reorder point, taking 30 days in a month. Prepare a statement, the total cost of procurement and a storage of raw material after considering the discount of the company elects to place 1, 2, 4, or 6 orders in the year. State the number of orders which the company should place to minimize the cost after taking EOQ also into consideration. So here we can see that, just a minute. Sorry. Yeah, so now here we can see that the question is having quite a few areas to pay attention to. So first thing is we are looking at quarterly production here. And they have given us the cost of placing an order of raw material. They have given us the carrying cost. They've given us how much units of input is required for the unit of output, which is very important. Then there is the lead time for procurement of raw material, which is 36 days, and a safety stock of 1,000 kgs of raw material is maintained by the company. We have the discount levels, and we are required to calculate the reorder point. So before we begin into anything, let's try to understand how to approach this question. So we can see that we are not having clarity on how much raw material is required, right? They have given us the input, but they've given it per kg, per unit of the output. Let's calculate how much input is required on a per annum basis. So we can see on a quarterly basis, 20,000 units are required. And for an annum, it will be 4 because we have 4 quarters. So 4 into 20,000, which will be 80,000 units. And for that, we will calculate the raw material. So let's proceed with starting our question. Here. So we have the computation of the raw material required. So we know that the annual production is equal to 20,000 units into 4, correct? So this is the annual production of the output. How much is the raw material required for this? It will be 80,000 into 0.5 kgs. So 40,000 kgs is what we are looking at for our raw material. ROQ 2000 kg. Oh, that's perfect, Rania. That's quick. That's great. How about the others? Were you able to calculate as well? So we have our raw material calculated here. Then let's move into our EOQ. So there we have our annual requirement of production is 40,000. Our order cost given in the question is 100 rupees. Our carrying cost is given to be 200 rupees. So our EOQ will be 2 into 40,000 into 100 divided by 2 square root, which is coming to 2,000 units. Is everybody following till here? Did everybody get 2,000 kgs as the ROQ? Is everybody following? Hello? Is it okay? How about the others? Okay, great. Okay, perfect. So you have arrived at the EOQ. So now once we have arrived at the EOQ, we will proceed to calculate the cost of procurement when the order size is equal to the EOQ. How much is that? Number of orders we know is going to be 40,000 units, which is the total divided by the EOQ, which is 2,000 units. So we have 20 units. Order cost is going to be 20 into 100 rupees, which is 2,000 rupees. And carrying cost is going to be your EOQ divided by 2 because you're going to only consider average into your carrying cost of 2 rupees, which is coming to 2,000 rupees. Your order cost is coming to, the total cost is coming to 4,000 rupees. So this is just to understand the cost of procurement when the price is equal to the EOQ. And another thing we will put into our okay. So if you go back to the question, the first part that is being asked to say, being asked to calculate is the reorder point. So this reorder point is nothing but we have calculated it to be the maximum consumption into the maximum lead point. That is your reorder level. Now the point here is we also have a special point in the question called safety stock of 1,000 kg of raw material. Please remember that whenever a safety stock is given, it has to be added to your reorder level. Your reorder level will be your consumption. So now we don't have maximum or minimum or average or lead. Those information are not there. So whatever information is given in the question, we will be taking that into consideration. So what is the information that is given in the question is that it will take 36 days lead time. Okay, so we will be considering 36 days as our lead time. So reorder level will be your consumption into the lead time plus your safety stock. So we know that the safety stock of 1,000 kgs is maintained by the company, and the lead time for procurement of raw material is 36 days. So how will we calculate this? We are going to calculate this as the consumption of 40,000 units. But now 40,000 units is going to be a consumption for the whole year. We just need it for 36 days. So 36 divided by 360 days will give us 4,000 plus safety stock of 1,000 will give us 5,000 kgs of ROI. Okay. So now let me clarify why we have done this 40,000 into 36 by 360. We know that the lead time for the consumption is 36 days, but 40,000 is the units that we require for a whole year. So we need to see what is the consumption that we will consume in the 36 days. If you remember that illustration that I had shown you, the first thing we'll do is we will have to calculate how much consumption we are going to use per day. So for simplicity purpose, we are using 360 days. 40,000 was for the whole year and 111.111 whatever is for a day. But we don't need for a day, we will need it for 36 days. We will multiply this into 36 days and we get a total of 4,000. So when we do a 4,000 plus the safety stock of 1,000, we are able to arrive at the total reorder level of 4,000 plus 1,000, which is 5,000. So at 5,000 units will be 5,000 kgs will be your reorder point. Rania, I see that your answer is 3412. Can you check where you have made the error or what is the doubt you're still having so that I'm able to clarify that issue? Is there some doubt with the calculation of any of these points? Hello? Okay, so is it clear now how to calculate the consumption? Okay, perfect. How about the others? Have you been able to understand the consumption calculation here? Okay. So we have come to a conclusion of the first part, which is the reorder point. This has to be very clear. The second is the total cost of storage and procurement after considering the discounts. So the order size, okay. So if you go back to the question, we need to prepare a statement showing the total cost of procurement and storage of raw materials after considering the discount of the company elects to place 1, 2, 4, or 6 orders in a year. So you can see that we have multiple discount levels, right? So what we are asked to calculate is the cost of procurement and storing of each level of the inventory. Now, when we go into the order size, we have we are asked to calculate for 1, 2, 4, and 6 orders. If you're looking at 1, 2, 4, and 6, so let's place this first. 1, 2, 4, and 6 orders is what we need to place. If you're placing one order, we will have a total order of 40,000, right? Because that is our annual consumption requirement. So there'll be only one order for 40,000. If you're placing two orders, we're going to place 40,000 divided by 2. So our order size will be 20,000 each. If you're going to place 4 orders, we are going to place 40,000 divided by 4, which will be 10,000 each for each order. And if there are 6, it will be 40,000 divided by 6, which will be 6,667 order size. So this will become our order size based on the number of orders we want to place. So what is the total cost of procurement? Total cost of procurement will be the number of orders into 100 rupees, because 100 rupees is already given in the question. So this will give us a cost of procurement, that is the order cost. Now, what is the average stock that we will have? So it will be the order size divided by 2, order size divided by 2, order size divided by 2, and then we will have our total cost of storage, because carrying cost will always be on the average cost. So this into our 2 rupees of carrying cost, 2 rupees of carrying cost, 2 rupees of carrying cost gives us the carrying cost. Now, when we look at the discount, here we are having an order size of 40,000. If our order size is 40,000, it comes under this range, which will give me a discount of 4,000 rupees, right? Then if I'm having an order size of 20,000, it will give me a discount of 3,200 rupees. If I'm having an order cost of 10,000, it will give me a discount of 2,000 rupees. If I'm having an order size of 6,600, it will give me a discount of 400 rupees. So my total cost is 3 plus 5 minus 6. So this will be my order cost plus my carrying cost minus my discount. So 36,100, 17,000, 8,400, and 6,867. So this is how the total cost will be calculated for each different type of order size for different levels of discount categories. Is this clear? Is point number 2 clear of how we calculated the total cost for the different order sizes? Okay. How about the others? Okay, great. Now we come to the third one, which is the number of orders. So what is the question? Let's go back. State the number of orders which the company should place to minimize the cost after taking EOQ also into consideration. So if you're looking at EOQ, we go back to the EOQ calculation. We know that we need to place 2,000 units of orders. Each order will have 2,000 units. So if you're looking at 2,000 units, then our number of orders will be 40,000 divided by 2,000, which will be 20 orders. So this will be our number of orders. And the total cost of procurement in this case will be we have to calculate the cost of procurement here. So we will have something as the number of orders, which will be 20 into 100 rupees, which will be 2,000, and cost of storage will be average inventory, which is 2000. Our EOQ is 2000, that's right? Yes. So it will be 2000 divided by 2, because we will take the average and we will be multiplying this with 2 rupees. That will give me a total cost of 4000 rupees if I am doing it at E. Is this clear, guys? How about the others? Were you able to find the total cost at EOQ? That's great. Any questions so far? Because this is bringing us to the end of the material costing topic. We have covered all the illustrations from the study material and all the concepts from the study material. So what I would want you to definitely do is practice more questions from the RTPs, the MTPs, and the past papers, so that you're able to get a better grip over these questions. The concepts remain the same, nothing changes with the concept, but it's all about application of the concepts to different types of questions. So I hope you have understood this session well. If you have any doubts, any queries, you can definitely reach out to me. You can ask me, and I'm ready to help and ready to discuss and resolve your queries. And if you have any questions that you would want me to discuss it in the class, I would also be willing to do that for sure. So just let me know if there's something that is still, that is not clear, or there's some confusion or some concept that is not sitting down too well with you guys. I will be able to resolve that here. Apart from that, it's a wrap from me, and I hope it was a value added session for you guys, and you were able to take back some good insights and inputs of the material costing topic. Thank you everybody. Is Ramshita there?
Okay, students, we are winding up today's session. So now it's time for your valuable feedback. So I think ma'am need your feedback for his better performance. Am I right, ma'am?
Yeah, for sure.
So students, let's give your feedback. Please
Thank
put
you,
it in the chat.
Arapa. You can definitely let me know what more can I add, so that it would help you all. Thank you. Thank you.
So ma'am, let's wind up.
Yeah, sure. Thank you so
Was
much, Ramshita.
so good class. You did it well. Thank you for your cooperation, ma'am.
Thank you. Thank you very much.